Good afternoon and welcome to Supply Chain BR Raw. Unleashing business growth, discovering hidden opportunities in your supply chain. This is the fourth in a series of webinars leading up to our feature in-person event, Supply Chain BR 2021, to be held this October 21st here in Baton Rouge. My co-host today is Jay Struther, Vice President of the American the International Warehouse Logistics Association. Sorry about that, Jay. IWLA's 360 members provide warehousing, fulfillment, inventory management, and value-added services to North America. Jay has made a career of supporting small businesses and larger industries. Early in his career, Jay served on the staff of the U.S. Junior Chamber of Commerce, the JCs. After that, he worked with many trade associations representing segments of the supply chain. Now entering his second decade with IWLA, Jay focuses on making third-party logistics providers safer, more efficient, and better prepared to serve customers like you.
Thank you, Robert. I really appreciate that. Obviously, my co-host today is Robert Baldridge, president of Wilson Warehouse and Speed Transportation right there in Baton Rouge, supporting Baton Rouge and East Texas manufacturers and distributors with warehousing, logistics, and transportation services. He's a graduate of LSU's engineering and business schools and has been at the helm of Wilson Warehouse for 21 years. He's a longtime member of IWLA, and so long that he remembers it being the American Warehouse Association, which we were until 1997. So now the International Warehouse Logistics Association. He's also served as president of the Southeastern Warehouse Association. So thank you, Robert, for helping us pull all this together and leading this. We also have a great group of panelists today who will help us teach you how to unleash your business. So I'd like to introduce our first panelist, Amy Province. She's a senior relationship manager at Regions Commercial Banking. She's a certified Treasury professional, and she provides commercial clients with solutions. She manages all aspects of a client's credit and Treasury solutions needs, even those outside the commercial banking area. So welcome, Amy. And also with Amy today is Carson Strickland, the Senior Vice President of Global Trade Finance at Regions Bank. Carson leads a team of trade finance professionals across 15 states and services a broad client base nationally. With 22 years of experience in trade finance and international banking, that gives Carson the ability to assist clients in trade services, export lending, support chain finance, and foreign exchange. Welcome, Carson.
And I'd like to introduce Faizan Ali, Director, Regions Business Capital. Expertise spanning asset-based lending, leverage finance, energy lending, and middle market lending allows Faizan to provide commercial clients with counsel regarding their capital management strategies. And Weston Garrett, Managing Director, Corporate Real Estate Solutions, Regions Bank. Weston leads the new Corporate Real Estate Solutions Initiative, working across all Regions industry verticals to identify and provide a variety of financing solutions in different markets. Weston has experience with sole investor transactions, sale leaseback, single tenant property financing, warehouse and distribution bespoke solutions, credit tenant leases, and more. Finally with us today is Dan Leonard, Vice President, Transportation and Logistics Group, Regions Bank. Dan directs a team of strategic financial professionals and counsels corporate clients within the supply chain corridor. Welcome, gentlemen. We have a few questions prepared to get the conversation started, but we welcome yours as well. Please use the Q&A tool located at the base of your window. We have a jam-packed list of topics to cover today. I'll try to incorporate as many questions as I can before we complete our session by 12:55 Central. Let's begin. Dan Leonard, this is to you. Dan, why is now a good time to expand your business?
Thanks, Robert, and appreciate everyone joining us this afternoon. I'd say, really it depends on where you are in your business cycle. But I think first and foremost, the supply chain disruptions that have permeated the market over the last 18 months, and again, are starting to come back a little bit with the Delta variant, have created a unique opportunity for businesses to immediately provide solutions to hungry customers. So, why wouldn't you want to grow now? In real time, any service provider, whether you're a capacity provider for freight or tonnage over the road, on the river, or coastwise, if you're a warehouse and you have additional square footage, or you provide value-added cold storage related services, transloading, intermodal services in and around rail yards and ports. I mean, anything that you can provide more to a current client or prospect, you're going to have a competitive advantage given the current climate. So, the transportation and logistics universe overall, as you think about it, imports, air freight, ocean containers have been so impacted by broader macroeconomic tailwinds and labor shortages that the ability to grow and provide these additional services now to fill immediate needs, I think not only in the short run will you be able to win, but clients will remember that going forward. So if you think about equipment and chip shortages, service delivery inconsistencies related to the labor market, as I previously mentioned, belly capacity in passenger planes, it's a unique situation for companies in the industry that really, if you can competitively interdict your peer at this point, you have such an advantage. So again, not to harangue the point, but back to your question, why would it be a good time to grow now? Why not? But not just additionally that, as you think about, and just as important about the environment, but the capital providers in the bank market, but also the dry powder providers, not just regulated banks, but family offices, traditional private equities, REITs, commercial real estate shops. They're all looking to provide resources and deploy their dry powder. So they're super receptive to growth initiatives right now. There are attractive rates and borrower-friendly terms. I think it makes a lot of sense to be looking, and the folks that have joined us today, and frankly, it's probably why they're here. So hopefully that answers your question and doesn't create 20 more, but the folks after me can dig in a little bit more on what is actually out there and specifically how you can go about when you do choose to grow or develop or build or acquire, whatever that word looks like for you and your business life cycle. Yeah, I would say competitively, it makes a lot of sense to invest and grow now.
Wilson, I think strategic relationships are a big part of that. Why is outsourcing supply chain operations an attractive financial strategy right now, do you think?
Well, I'll take that one, Jay. First, let's talk about core competencies. You make a good product. No, you make a great product and you're good at making it. That is your core competency. However, stressing about warehousing, fulfillment, shipping, reverse logistics may distract you from your core competency of producing that great, terrific product of yours. Partnering with a third-party logistics supplier and outsourcing that part of your supply chain with an expert in fulfillment, inventory management, kitting, and other value-added services and reverse logistics can allow you to focus on those other core competencies of yours. Now let's talk about assets. If you're doing your own warehousing and shipping today, you've got a building to do it in, and that building is either too full or too empty. If it's too full, your production folks you're squeezing them out of their space. If it's too empty, your production folks are wondering why they can't take it over. Meanwhile, you have a capital investment, either a long-term lease on the building or you actually own the building. If you outsource with a third-party logistics provider, first in the words of the insurance company, you only pay for what you need. You only pay for the space you're covering. You only have the labor that you actually use. It's the third-party logistics provider's job to make efficient use of the space, and you are only hit with what you need. Meanwhile, you have freed up a building that you might be able to, if you're leasing it, you can get out of it. If you own it, you can lease it to someone else. You can sell it to provide immediate capital. You could do a sale leaseback and move your production into it. It's a source of financial capital that you can tap. But there's also capital in your employees. Dan was mentioning earlier that it's harder and harder in today's society to hire the quality workers that you need to produce your product. If you outsource your logistics, those people, your employees, your golden employees that are working in that field today, can be moved to that production side. So it's providing you not just financial capital, but also human capital to help grow your business. So utilizing a third-party logistics provider frees up financial capital and people to grow your business. I want to move the next question to Amy Province and talk about what traditional finance tools fuel your business growth, Amy.
Great, thanks, Robert. So Regions offers your full traditional commercial suite of banking products and credit tools. That's from working capital, lines of credit secured by accounts receivable and inventory, with typical advance rates of 80% on eligible accounts receivable and 50% on inventory. That can help you when there's a cash flow gap between purchasing inventory and paying receivables, or receiving payment on receivables. Equipment finance and leasing. So we will provide up to 100% financing on new equipment. And then of course the terms on that depends on the useful life of that equipment. We'll offer guidance lines of credit. So if you have a capital plan that includes new equipment over the next 12 to 24 months, we'll put a line in place that'll allow you to fund whenever you need it, so that you're not having to come to the bank with a request every time. There's something in place where you can use it as a tool and know that it's available whenever you need to go make purchases. And then of course, owner occupied real estate, we love that. Up to 85% loan to value, 15-year terms, 20-year amortization. If you can get the loan to value to 80%, we're offering special rates on that type of financing. And then you've got your SBA loans. So 504 loans where the bank provides 50% of the capital, the SBA provides 40%, and then the borrower puts in a 10% equity injection. And then lastly, 7A loans can help borrowers with acquisitions, and particularly whenever there's some sort of collateral shortfall, and then financing equipment that perhaps you might not finance in a traditional bank situation. But outside of the traditional products and services that the bank offers, we have a whole team of specialized groups that can help with specific needs that our clients might have or potential clients might have.
And that's what Carson does with you guys, right?
Correct.
So Carson, can you shed some light on maybe some of the more specialized financial tools that are available now?
Yeah, absolutely, Jay. So if you notice my bio, I work in the bank's global trade finance group. So as the name implies, a lot of what we do is specific to companies that have import and export activities in their business, which that's a critical part of the supply chain. And as everyone that's in this meeting knows, has been one of the more complex parts of this physical supply chain over the last couple of years. Container shortages, lengthy transit times, it's that part of moving goods around the world is the most challenging, right? So really wanted to talk about that today, ways to alleviate some of the stress in the financial supply chain, and then also ways to mitigate risk. So on the risk mitigation side, when we have companies that want to grow their international business. They want to sell more. 95% of the world's population is outside of the U.S. One of their main concerns is the financial risk, making sure they get paid. So there's a lot of tools to help mitigate that. Some of the bank products are things like letters of credit. Y'all probably heard of that before. You kind of put a bank into that payment process to make sure payment happens. Documentary collections is a way to leverage sort of the title transfer of a product with payment. And then there's other products like trade credit insurance that banks don't necessarily sell, but we utilize for financing to help mitigate that risk. So that's really about go out and sell more, be competitive on your terms, but not worry so much about not getting paid, right? There's ways to mitigate that. Likewise, on the import side, companies that are importing, they've found sources for products that are more competitive than maybe what's available domestically, or maybe what they need to buy is not available domestically in a lot of cases. The flip side of that risk is if you're prepaying that supplier overseas, that's a negative impact on cash flow and working capital, but there's a risk to that. You got commercial risk, sovereign risk, et cetera. So some of the same tools I mentioned earlier, LCs, collections, also things like supply chain finance. How long can you hold on to your money before you pay that vendor overseas, or things banks can help with. On the working capital side specifically, our government doesn't always do things we want the way we want them to do, but a couple of things they do well is support the working capital needs of exporters. And so the government's got two programs, one's through the Export-Import Bank of the United States and one's through the SBA, where they'll actually step in and give banks loan guarantees, not 100%, but still good loan guarantees to facilitate lending to exporters. And so Faison was going to talk more about asset-based lending in a minute. So this is really kind of a complement to that. There's parts of a borrowing base, the sort of borrowing capacity a company has for working capital that banks don't always like. And some of those things are like foreign accounts receivables, purchase orders that are issued by foreign buyers or higher risk, and banks may not be keen to lend against that. But these programs allow that to happen. I talked about trade credit insurance a second ago. That's another way if you're a company that that's credit worthy and you've got a line of credit that's secured with receivables and inventory, but there's a foreign receivable component in that that's getting pulled out. Oftentimes, if those receivables are covered with trade credit insurance, they'll become eligible in your borrowing base. And again, this is all about accelerating injection of working capital into a business to help grow international sales. Quickly on the import side, again, with supply chain disruptions, lengthening supply chains, it's important for companies to match their financial supply chain to their physical supply chain as much as possible. And that's really centers around extending your days payable outstanding. So banks have tools to do that. Some of that's traditional trade services that I mentioned earlier, letters of credit and collections, but also supply chain finance tools where U.S. importers are able to basically go to suppliers and say, hey, I need 90 days, I need 120 days or whatever to match up the physical supply chain, my ability to bring in goods, process them, and resell them with the financial supply chain. But doing that in a way that doesn't have a negative impact on the supplier. And the other thing I'll mention, and this is just really more intel for the group than anything else, we companies that import significant amounts will typically have to post customs bonds. And so that's a surety product that covers the import tariff, import duty exposure that's payable to U.S. Customs. We've noticed over the last really 3 to 4 years, with rising tariffs, rising import values and import volumes, those exposures have increased. So the potential exposure an importer has in import duties has gone up. And so these surety companies will often require standby letters of credit to backstop that surety exposure. So just be mindful of that if you're an importer. and you're seeing that activity increase, the dollar amounts of what you're bringing in the country increase, your surety company may ask you for that. And so that's another specialized bank financing tool that we and other banks offer to importers. That's it, Jay.
Thank you, Carson. And you set up Faison Ali. How can asset-based lending fuel your business growth? And give me a strong definition of asset-based lending, please.
Sure. Thanks, Robert, and good afternoon to everyone. Asset-based lending, really, as the name implies, it's a mechanism, it's a financing solution that can really allow you to leverage your assets that you're utilizing in your business to really get an efficient and flexible financing solution. So one thing that I'm really focused on is like, how can I bring you the maximum liquidity that you need to fuel this growth that you have for your business, right? And many times, like Amy mentioned, right, you have the traditional products and then you have asset-based products. So traditional products, your borrowing capacity can be limited based on a multiple of your earnings. So if your earnings do get hit, then your capacity decreases and you're not able to fuel the growth you need. Well, with an asset-based facility, like the great part about that is that it responds to your business. So if your business is ramping up, if the demand is ramping up, your operations are ramping up, then you can take advantage of the increase in assets, your receivables, your inventory, other rolling stock that you have. We can give you capacity to borrow on that asset. So again, one of the key differences between an asset-based loan and a traditional loan is, that borrowing capacity that you can borrow from a bank is derived on the assets. And typically, like the main assets that we incorporate are accounts receivable, inventory, and fixed assets. And we can also lend on real estate, but the products that I really focus on are, revolving line of credits and term loans. And again, for within my team, our commitments range from 10 million and up. And the great part about Regions is that we can bring in other specialized partners like Carson to even get you more availability, when there are, like if you have foreign operations, you have import-export activity, so we can combine the two solutions together. During this pandemic, it's been a pretty crazy time, and I know a lot of management teams that I've talked with, their cash flows were impacted, and that really kind of tripped a lot of covenants that they have with their banks, and it's really kind of becomes a painful process where you're trying to manage your business, but at the same time you're having these challenges because of the covenants you have. One of the great things about asset-based lending, it's very covenant friendly. So oftentimes you're only going to see one covenant. So it's really we get, as lenders, I get the benefit of assets that there's collateral coverage that I can monitor. So typically, Carson mentioned this, that each month we have a borrowing base that our clients fills out, and within the borrowing base we have the client will write the amount of receivables, the inventory, and the assets that we're lending against, and then there's a formula in which I will lend up to 85% on the receivables, and then on the inventory and equipment we'll go up to 85% on the whatever the appraisal we get. So we try to go as deep as we can to maximize that liquidity that you need for the growth. So again, you can use asset-based financing for working capital, for growth and expansion, for any M&A activity that you have. And like the key benefits are that it's going to be pretty covenant friendly, so you're going to have a lot of flexibility from that perspective. And then you're also going to get a lower cost of capital. Pricing is generally lower for an asset-based loan versus a traditional loan. So you get better pricing, you get more covenant flexibility, and you can get a longer tenor for your facility. So most of our asset-based facilities, you'll get a 4 to 5 year deal. So you will have long-term financing in place. You don't have to worry about renewing something, after 2 years. That's another key benefit, that you can get with asset-based lending. So I hope that answers your question, Robert.
It does. Well, okay. It opens the door for more questions. But thank you very much.
That's what I was thinking. You mentioned it's been a crazy time, and nowhere is it more crazy than real estate. I don't think things are very strange in the industrial world. And I know that maybe Weston Garrett can help us out and talk about how corporate real estate solutions can also help fuel your growth.
Kicking it old school. Thank you, Jay, and happy to do it. We're seeing some really interesting trends right now, and there's some recent research that was done by Brookfield's fundamental income subsidiary that points to about 3 trillion of real estate sitting on the balance sheets of U.S. corporations. That's a lot of collateral that can be used to help facilitate attractive lending solutions, or that can be monetized through sale leasebacks if that's the company's preference. The number of companies that are using sale leasebacks or build-to-suit solutions for the real estate continues to grow, and we've seen about a 20% compound annual growth rate in the single-tenant properties that are held by the net lease REITs, including names like Realty Income or Store Capital or WP Carey or Stag or others. In the current environment, industrial assets are the number one priority list. Multifamily is certainly strong as well, but multifamily industrial are two things that certainly our bank is looking to lend against or to help clients monetize. And I think that's true across the rest of the real estate lending universe. So warehouse, distribution centers, truck terminals, maintenance facilities, intermodal locations, some of which have not really been in favor, really are at this point in time because of the continuing e-commerce transition that our economy is going through. So just as physical retail, mall properties would probably be the best example of fallen out of favor. What's come back in favor is everything that goes into the e-commerce supply chain. Prices for industrial assets are approaching all-time highs. And if you look at some of the recent research from Green Street Advisors, we can see that the average industrial asset, and certainly there are market discrepancies, but on average across the U.S., industrial properties, warehouse distribution are up about 20% during the last 18 months, so during the period of COVID. So a lot of capital chasing these opportunities, prices are being driven up. We're also seeing some increases in construction costs starting to materialize. Lumber prices earlier this year are very well publicized, but now we're seeing that creep into concrete and steel and roofing. So just be aware of that to the extent that you're exploring new construction. On the new construction front, companies that are looking to outsource their capital expenditures for a new warehouse or distribution property can do that through a build-to-suit lease, in which case an investor would step in and acquire the land on your behalf. They'd fund 100% of the construction cost, and then you'd enter into a long-term lease once the construction of that particular property was complete. It's an elegant solution in that the company really has no capital expenditures or no out-of-pocket costs until the asset is open and operational. So there's a very good revenue expense match going forward, as opposed to a situation where you're building the asset directly on balance sheet, either using equity capital or debt. And in particular, if you're using debt, you've got the leverage impact before the earnings impact, which can get you out of whack a bit. So build-to-suit leases are a very good solution for companies which are going through high growth periods. And there's probably no better example than Amazon, which uses this for almost all their new construction. These build-to-suit structures do provide 100% of the cost to fund the new asset. That can also be paired with a REFCO, equipment leasing solution for the racks, conveyors that go inside the building. But think of this as a great tool to be used as the company shifts to growth. Sale leasebacks for companies which are have existing assets on their balance sheet that want to monetize in a very attractive cap rate environment. Cap rates or lease rates right now are at all-time lows, no different than what you're seeing in the financing markets. But because the 10-year Treasury, which is the normal benchmark we look at, is still 1.25% thereabouts, it's a very attractive time to look at a sale leaseback as a funding tool. Companies will be entering into a 10 or 15, sometimes a 20-year lease on the back end, and they're freeing up the equity capital, which has previously been invested in that property, to repatriate that for future growth initiatives. There are no financial covenants in either a build-to-suit or a sale leaseback transaction. So just like Faison said on the ABL side, these are fairly attractive solutions that give the company a lot of flexibility as they go through different economic cycles going forward. And to the comment that Robert made earlier about only pay for what you need, sale leaseback and build-to-suit transactions both give you the right to hand back the keys at the end of the intended occupancy period and go on to a bigger location, a different location, chase a different market depending on what the company's needs may be. So you've shifted that residual risk off to a third-party investor. For those individuals or those companies that want to retain that residual risk, they've got a positive view as to what that property is going to be worth going forward, then a real estate term loan or single-tenant mortgage financing can be an attractive alternative. Interest rates, as mentioned, all-time lows, and so LIBOR and so forth, the short-term borrowing indexes less than 10 basis points right now, and financing costs for a 5 or even a 10-year commitment It could be as low as 2.5 or 3% in the current market environment. The advance rates we would have from Regions' perspective for very well located assets could approach 80%. More normally, they're 65 or 70% loan to value. So it depends on the quality of the tenant and or the occupant and quality of the real estate. But that's the general range to be thinking about. So if you're comfortable taking the residual risk or believe there's upside in the properties which are part of your network, then the real estate term loan may be the superior solution compared to a leasing alternative. At the Regions, we've got about a $6 billion portfolio of owner-occupied real estate. We continue to find ways to grow that book of business. We also have a 5-year partnership with Stonemont Financial, which is based out of Atlanta. It's a $3 billion of assets under management private equity group, and they are helpful in serving our clients sell lease back and build-to-suit needs. So with that, I'll turn it back to you.
Well, and you kind of touched on this, but I mean, as a manufacturer or as a business, what factors should I consider, before I decide whether to finance or lease?
I think there's a couple different things that play into people's thought process. The first of which is the use of capital. Is there a better return that you can achieve by investing that capital in your core business, or is real estate the right place to expend those dollars? Real estate historically, and right now we're in a bit of an anomaly as it relates to the recent appreciation for industrial assets, but historically real estate's appreciated about in line with inflation, 2 or 3% a year. So if a 2 or 3% return on invested capital is something that works, then perhaps a real estate investment makes some sense. There has to be a view on the residual value of the asset as well. If you're comfortable taking that residual, if you think you've got a market which is going to show some above average appreciation, then ownership becomes the attractive pathway. So what I would say is if companies have higher return type opportunities, then leasing becomes a very good solution. If they believe that they're an exceptional market and want to take that real estate residual risk, then financing is the pathway. And I think as we sit down and coach our clients, it's really, we can explore both pathways. We're agnostic as to which approach a client may go, just making sure we find the best fit for the force rank priorities they're trying to solve for.
Thanks, Weston. I think maybe Robert, or do you?
Yeah, I was muted. Typical first timer mistake here. Thanks, Weston. I appreciate that. And I might follow up. I think I heard Amy say 80% loan to value, and 3% was what I heard from you as far as the rate. Or maybe I'm interpreting those to my benefit. We'll see. My next question is to Amy. How can Treasury Solutions fuel your business growth?
Great, thank you, Robert. So we wanted to just share with you all kind of some tools that clients have used over the pandemic that have helped them to either extend their working capital cycle or, make their back office function a little bit more efficient. One of which is the commercial card, which can give you up to 45 days of cash flow cycle. So if you are putting your payables on a card product and you're not paying for them until the next month, you're not tapping into a line of credit. You're keeping the cash available in your checking account or your operating account. And it can act as a very great tool while there's no interest to be earned. You can also potentially be earning a rebate for yourself. Secondly, integrated payables is something that we saw a lot of usage of during the pandemic. So basically what happens is you send us a file of all of the payables that you'll need to send out, whether that's ACH, whether it's checks, wires, card payments, whatever, and we process all of that for you. So you don't have someone in your back office printing checks, signing checks, putting them in envelopes, whatever, all of that stuff that can be more efficient and can potentially, gain you an expense savings, maybe not a revenue earning, but an expense savings. And then lastly, integrated receivables, which kind of does the same sort of thing, but on the flip side of the payables, and that, we're helping you to manage and get those invoices to the specific clients on your records as you're receiving those payments. So just some added solutions on the Treasury side to go with all of the credit tools. Robert?
Yeah. Thank you, Amy. I have a couple of questions that I'd like to interrupt us and ask right now. And so, Amy, I'll give this to you, but you have your whole team here. It says, can your team help us evaluate various financial models to plan our expansion? For example, what is the right balance of outsourcing and financing to achieve our desired goal?
Absolutely. I think, that's probably something, if outsourcing is a part of what you all do, Robert, that could be something where we could work together. But yes, we can help you say, here's how much capital and here's how much financing would make sense based on what your goals are and what your balance sheet provides. Absolutely.
Thank you. I have another question, but I'm going to save that for Jay in just a minute. So we have a little bit more, but wait, there's more. Jay, how do you find strategic partners? You got to unmute yourself, Jay.
Sorry, Robert, I was following your lead.
Yeah.
That's a great question, and you kind of touched on it earlier. That if you're finding partners, you want to find one that supplements what you're doing and has the right core competencies, so you don't have to develop those yourself. And it takes some research, it takes some work, but if you start looking in the right place, you want to find a business partner, whether it's a banking relationship, whether it's an outsourcing relationship for warehousing or transportation, somebody who understands your business or takes the time to understand your business. That there are nuances to what you're doing, but we as providers of those services may have figured out a way to do it efficiently for you. That's what we're here for, is to make it so you don't have to worry about those things. So you want somebody who will understand your business and also help you find creative solutions. You don't want to have to be going to them with your strategy. You want them to take their best practices and come to you and say, hey, have you ever thought about doing it this way? Not forcing you into something you're not comfortable with, but giving you the options to understand. And there are lots of places to go looking for folks. Obviously, you have developed relationships with the vendors and suppliers you are using now. Those are a great place to tap because they have other clients who may have come up with have encountered some hurdles or obstacles or ideas that you're facing right now. Turn to them and ask. For warehousing services, of course, we hope you come to IWLA. We have existed for 130 years, and we've been supporting the warehousing and supply chain industries, making sure that warehouses are up to date on the latest in technology and safety and the things that really affect you as a person, as a client who's tapping into those services. We have a way that you can find a warehouse through us. If you go to our website, which is iwla.com, and just click right on the homepage, right below the slider boxes at the top, is a Find a Warehouse button. And you can search by keyword, you can search by geography, and we will help you find a North American warehouse that can help you do what you need to do. Beyond that, we also have other tools. We have a subset of our members who are partners in the industry, and those are companies like banks and racking companies and material handling companies and things. So if you are trying to do that even in your own time or through your warehouse, you can find those partners through that too. And I do recommend that. There are trade associations like ours for every segment in the supply chain. And that is a great place to start because the companies that are interested enough to invest in their employees' professional development and their businesses being able to stay on the cutting edge, they take the time to be involved in associations like ours, like Robert has been. So those folks you can find through our website are a great place to start, and also people who are on these webinars like us, like Amy and her team have been a great resource, and they're here for you to tap, and you'll get their contact information. But Robert, I think that's part of the strategy, is to find the right strategic person, the right strategic company that will help you grow as a company.
Thank you, Jay. I have a couple of more questions, so we can go to the Q&A. And the first one is, For those who never outsourced supply chain operations before, warehousing, inventory management, transportation, and are concerned about the impact on their team, is there a way to ease into this business model like a short-term contract or other? And Jay and I will answer that. I'll start off. One thing, when I mentioned that you only pay for what you need, that's the way it works. If you have an existing operation and you want to outsource a little bit of it, let's say some overflow, you might take one of your market segments. There's a lot of trust involved. You need to, it's not, in the logistics, it's not a transactional situation. You know, you're entrusting your product to someone else to steward your product to the customer. And so you need to develop a relationship with them, a trusted relationship. And that means getting to know them. For instance, if you're in the business to consumer fulfillment operation, you need to know that provider is strong in that area or is capable in that area. If some of your product requires kitting or remanufacturing, you need to find somebody who's strong in that area. The good thing about working with a third-party logistics provider is you can ease into it. You can give them one product line, you can give them overflow. You can do a lot of things with that in little bits and pieces, because you don't have to go out and buy a 100,000 square foot warehouse and give them 3 truckloads to deal with. You only pay for what you give them, and so that allows you to ease into it, to ease your customers into it, and you may find that third-party logistics provider has some tools that your customers like. Tracking their inventory, all sorts of online resources that you and your customers will appreciate having available to them. Jay, I'm going to kick that back to you.
No, I think you're right. You're right on track, Robert. And one of our former board members, Ken Johnson from Shippers Warehouse in Dallas, said that, you know, third-party warehouses exist to solve problems. That if you have a problem that you cannot, a supply chain issue that you cannot or you don't want to tackle within the walls of your own business, turn to that third-party provider. They love it if you come to them for the problem, and even that's the first time you go to them. They can help you solve it, and you can build that relationship. They're there to solve problems every day. They're also there to bring that expertise. So Robert's right. If you are a B2C company, you find a warehouse that has done B2C work, and they will be able to bring a much broader perspective to you. So I think you know, dipping your toe in the water in whatever issue you have right now is a great place to start.
Thank you. Amy, this is going to be for your team. What distribution and manufacturing industries are most attractive to banks and investors right now?
Faison, I'll let you answer that, because you probably see a lot more broad in our region than I do.
Yeah, sure, Amy. So, Robert, you know, we're industry agnostic, so we're not, you know, tied to a certain industry. But I'll tell you that obviously, you know, we're seeing a lot of, a lot of industries that are tied to the commercial and industrial nature. So, you know, paper, packaging, food and beverage, chemicals, plastics, building materials. You know, those are a few that I can just name from the top of my head. But again, you know, as long as, you know, like it's, you know, we're industry agnostic, so we'll take a look at everything. But those are a few of the industries that I'm seeing a lot of activity in.
Thank you. Another one for the group: how does growth in Baton Rouge compare to the rest of the United States? Is the pandemic going to change our growth trajectory for the balance of 2021 and 2022?
Dan, maybe you can take that one.
Amy, I'll chime in first and then Dan can complement the thoughts. But I think broadly across the United States, the cities and states that are part of those smiles, so think about the coast of California on down through the central southern United States and then up to the Carolinas is really where most of the growth is taking place. And I think that growth trajectory is going to continue to be fairly pronounced going forward. So the New England area, the central and upper Midwest is where we're seeing slower growth, and certainly the Smile States are where we're seeing the most growth. And so Baton Rouge is certainly a beneficiary of that, and we would expect positive conditions into the foreseeable future.
Yeah, sure. All right.
The one single invention which has had the greatest impact on real estate values is air conditioning, and you guys are clearly a beneficiary of that.
Thank you. Thank you, Weston. We're getting close to the end. They keep telling us about, we're about to run out of questions here. I would like to put up the contact information. These are our panelists. This information will be available on the Supply Chain BR Raw website. If you have any questions for these folks, here is their contact information. I'm going to leave it up for a second so you can write their names down. And then I have my commercial, and that's for a Supply Chain BR. I think we have a slide for that as well. Thank you to all that have participated. What a strong crowd we had from regions of quality people. I think we picked up a lot from the information we received today, and frankly for me it was more questions than arose from it. So thank you all panelists for your hard work. Now, here's my commercial, Supply Chain BR 2021, Unleash Your Business Growth. It's going to be October 21st from 8 o'clock to 3 p.m. We'll have breakfast and lunch, and we'll have an after function that won't be technically part of it, but it'll be nearby. We have Regions is a primary sponsor of that, along with IWLA and Wilson Warehouse. We'll bring together people who need support in the logistics industry, in the supply chain, but also we'll bring in some supply chain providers, and you'll have several opportunities to meet with them and find out just what they can offer you. I look forward to seeing you all there. I see down at the line, if you register by September the 3rd, it's there's a nominal charge. There is a charge for attending, and the early bird rate goes through September the 3rd. I'm seeing the clock is pushing us to the end here, and we have covered the questions. And according to my phone, it's 12:55. And so, Hank, I think we can end the webinar here. Thank you all. Thank you, attendees. Appreciate
Thank you, Robert.
you here. Bye.
Take care.